often, you as a real estate investor, you're trying to figure out what entity you should structure. This step is so important as it determines what kind of taxes you will pay and how you will be able to leverage the tax code utilizing specific tax strategies tailored to real estate investing. So we're going to discuss 2 buckets you must consider when choosing which entity is right for you. So let's get right into it. When it comes to structuring your entity for real estate investing, there are 2 buckets you need to consider. You have the active side of real estate, where you're involved in the day-to-day operations of the business. This bucket includes real estate investors like your flippers, wholesalers, dealers, real estate agents, or property managers, just to name a few. On the other hand, you have the passive side of real estate, where you are not involved in the day-to-day operations of the business. In this bucket, these real estate investors are considered landlords or anyone who holds property long-term for passive income. So basically, if you buy and hold rental property. As a real estate investor, when you fix and flip properties in your name, you are considered a sole proprietor. You fall into the active bucket, so you are required to pay self-employment taxes, which is made up of 12.4% of Social Security taxes and 2.9% of Medicare taxes, which equals the 15.3% in self-employment taxes that you must pay when you file your federal tax return. Some may consider this as double tax because when you were an employee, the employer actually paid half of this tax, which is around 7.5%. This was your Social Security and Medicare taxes, while you as the employee paid the other half. However, because you are now self-employed, the IRS looks at you as the employer and the employee, making you responsible for now paying the 15.3% in self-employment taxes. So the maximum amount of money that you will have to pay self-employment taxes is $160,200. Any amount higher, you will only have to pay the 2.9% of Medicare taxes only. For example, let's say your net profit is $300,000 from flipping properties. You will have to pay self-employment taxes on $160,200, which is around $19,864 for the Social Security taxes. And then you will have to pay the Medicare taxes, which is $8,700 for the full amount of the $300,000. So you may feel the impact even more because you do not have that employer to share the burden of these taxes with. I actually teach you in my How to Pay Yourself video how to strategically set aside monies for the self-employment taxes that I will link after the video. So do you have to pay self-employment taxes as an LLC? If you fix and flip properties in your single member LLC, you are also subject to self-employment taxes because your LLC is considered a disregarded entity, meaning the IRS does not recognize your LLC as a separate tax-paying entity. It is what we call a pass-through entity. You pay your taxes through your personal tax return, your 1040, through a Schedule C. If you are considered a multi-member LLC, you file what we call a 1065 tax return. You still will be very similar to a person who has a single member LLC. Your taxes will pass through your personal tax return and you still will pay the self-employment taxes. So for example, Brandon, a real estate investor who flips properties, is set up as a single member LLC. He made $300,000 in active income, but his net profit was $150,000. He has to pay the 15.3% of self-employment taxes on this, which is around $22,950, not including his federal and state taxes he has to pay. So you have your ordinary taxes that you pay every year, and then because you're a single member LLC or a disregarded entity, you automatically have that 15.3% in self-employment taxes on your active income. The goal as a real estate investor that has active income is to save the most money on taxes by leveraging the tax code. Also, because you have active income, you want to eliminate the unnecessary self-employment taxes that you have to pay. So how do we eliminate the self-employment taxes? You do this by changing how you are taxed. So most entities start out as an LLC, then they can decide how they want to be taxed as either an S corporation or a C corporation. So when you decide that you want to be taxed as an S corporation, you must make yourself an employee of the business and pay yourself a reasonable salary according to the IRS. Let's say you decide to have your LLC taxed as an S corporation. You can now pay yourself a reasonable salary on a portion of your active income, allowing you to avoid self-employment taxes on the rest of your income. So the rest of your income, you can take what we call a distribution, avoiding the self-employment taxes on that portion of the income. You only have to pay ordinary taxes on the distribution. For example, Brandon, who's a real estate investor who is a flipper, made $300,000 in active income. He decides to structure his business as an S corporation. So he takes a reasonable salary of $80,000, leaving him with $220,000. So the $80,000 is subject to the 15.3% of self-employment taxes, which is $12,240. The remaining $220,000 is not subject to the self-employment taxes. Now, if Brandon decided to stay an LLC or sole proprietor, he would be paying self-employment taxes on the full $300,000, the 12.4% on $160,200, and then 2.9% of Medicare taxes on the full $300,000. That is $28,564 in self-employment taxes. So as you can see, by Brandon, who is a real estate investor who flipped properties, deciding to be taxed as an S corporation, he was able to save roughly $16,324 in taxes, which is a big deal. So let me know in the comments if you think this strategy will work for you. Something to remember, the $220,000 that is not subject to self-employment taxes is reported on a K-1 and passes through your personal tax return and is taxed at your ordinary tax rate. So what happened was Brandon can actually take a distribution of $220,000 and pay his ordinary taxes, which may be 15% on that amount. So how do you elect to be taxed as an S corporation? So in order to be taxed as an S corporation, you first want to make sure that you speak with your accountant to make sure that this is the correct structure that you need in order to maximize on your tax savings. So once you do this, you can now have your LLC to be taxed as an S corporation by filing Form 2553 with the IRS, electing to be taxed as an S corp. You must do this by March 15th if you want your S corp status to be effective for the current tax year. If not, you will possibly have to wait for the following year for your S corp election to become effective. You must make sure that you determine your reasonable salary that you must take as a shareholder. The IRS has very strict rules when it comes to reasonable compensation, preventing you from underpaying yourself as a shareholder. Now, this is very important that you remember this. S corporations and partnerships must file a tax return by March 15th of each year instead of April the 15th. It's so important to make sure that you're consulting with your tax strategist to ensure that your business tax strategy is implemented correctly so you can avoid any missed deadlines or compliance issues. The IRS has a very, very strict guideline for S corporations. Now let's dial back to passive income. So what are the benefits of having passive income? Now on the flip side, as a real estate investor who buy and hold properties, if you're buying and holding properties in your personal name, you are a sole proprietor. Now you as the real estate investor may have an LLC, which is great because it provides liability protection to your rental properties. So if someone decides to sue you, they only have access to the assets in your LLC. If you buy and hold properties, you are not subject to the 15.3% of the self-employment taxes. The rental income that you receive either as a sole proprietor or a single member LLC or partnership passes through your personal tax return through a Schedule E, avoiding the self-employment taxes. Something to remember, do not put your rental properties in an S corporation, and here is why. If you put your rental properties in a corporation and you decide to sell or transfer the property, you will trigger a taxable event. So for example, if you want to transfer your property from one entity to another, it will be treated as a sale at the fair market value, and you will have to pay taxes on that gain, which is capital gains taxes. For example, Leora transferred her rental property that she purchased for $150,000 to her S corporation. Over time, her property appreciated to $350,000. Now, when Leora goes to transfer the property, the fair market value is now $350,000. She will realize a gain of $200,000 on which she will be required to pay capital gains taxes. So if her capital gains rate is 15% of the $200,000, she's required to pay $30,000 in taxes just from transferring her property and they recognizing it as a sale. So what are some advantages of having passive income? So having passive income gives you so many benefits within the tax code that you as a real estate investor can take advantage of. So some of these benefits include depreciation. So when you own rental property, you can leverage depreciation as a tax deduction. So for example, you have a rental home with a basis of $300,000. If you depreciate this rental property using straight line depreciation, you can take $10,909 as a tax deduction. Now, if your tax rate is 24%, that's a $2,618 in tax savings. You also have the ability to do 1031 exchanges. So you can exchange properties and defer the taxes on the exchange. So for example, let's say you sell a property for a profit of $200,000. Normally you owe taxes on that, but with the 1031 exchange, if you reinvest the $200,000 into another property, you can defer paying taxes on it. So you get to keep the money growing in real estate without Uncle Sam taking a cut until you decide to sell the property. Another benefit to having passive income is you can do what we call a cost segregation study, allowing you to accelerate depreciation on your rental property. So for example, let's take the same rental home for $300,000. By you getting a cost segregation study done on the rental property, you identified $200,000 worth of personal property, like the lighting, the fixtures, and the furniture that qualify for accelerated depreciation. Now, under the current law, you can take 60% of bonus depreciation. So you can take $160,000 as a deduction on your taxes. So if your tax rate is 24%, that's a $38,400 in tax savings. These are just some of the benefits to buying and holding property. So what's the best entity for fix and flip real estate investors? So if you're a real estate investor with active income, the best entity is an LLC taxed as an S corporation, allowing you to bypass the self-employment taxes, saving you tens of thousands of dollars in taxes. So what's the best entity for buy and hold real estate investors? The best entity to have your rental properties in if you buy and hold is an LLC that you can easily sell and transfer the property from one LLC to another without triggering a taxable event. Not to mention the liability protection that the LLC provides. So you learn some key points to consider when it comes to making sure that you choose the correct entity for real estate investing. You now understand how self-employment taxes affect your active or your passive income, the advantage of S-Corp taxation if you're an active real estate investor, and the benefits of passive income tax strategies like depreciation, cost segregation, and 1031 exchanges. Remember, choosing the right entity structure, whether you're flipping properties or holding them for rental income, affects your tax liability and the tax strategies that you can possibly benefit from saving tens of thousands of dollars. So do you have active income from real estate investing or passive income? Let me know in the comments. Also, if you found any value in this video, like, share, and subscribe. And if you would like to learn more about real estate investing and different strategies that you can do, check out our videos above. From Everlife Accounting Group, my name is Karina, and thank you for tuning in to another episode of Financial Sense.